Well, thank you, Fred. It's a pleasure to be at it once again, though I would say today's attendance probably testifies more to the eminence of my colleagues on the panel and to the drawing power of a free lunch than it does to the subject of economic forecast. 2 years ago, when we had this meeting, we were at the depths, it turned out, of the great global recession. And the question was what Alice asked, down, 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 when will it ever end? And then what will the recovery look like, an L or a V? Oops. Well, the results are in. I would say that's a V. Looking forward to global economic prospects, this is the summary. We see the evidence of the other key feature of the global recovery, a rather sharp divergence between the powerful recovery in emerging market and developing countries and the anemic recovery in the advanced economies. The recovery in developing and emerging market countries has been sufficiently strong that they are now not only above where they started the Great Global Recession, but nearly back to their potential output level in most cases. And the forecast looking forward is basically that they're going to grow about in line with what I estimate their potential to be. For the advanced economies, we have not yet recovered our loss in output in the recession. The US has just done it. Canada is a little ahead of us. Everyone else, basically, in the advanced economies, at least in Western Europe and so forth, is still not back to where they were. So there's still an important output gap to close, and I think we're going to begin closing it, but at a pretty sluggish pace. So that's the basic economic forecast, which yields an estimate of 4.3% year-over-year growth next year and 4.5%, a little bit stronger the year later. Now, there are a lot of risks to this scenario. The turbulence that we've seen recently in the Middle East and the uncertainty about the movement in oil prices. The increase we've already seen is certainly a negative for growth in the near term, but it could go higher, it could go lower. Other prices have been rising pretty rapidly for commodities, which have been eating into consumers' real incomes, and the general inflation rate has been picking up and occasioning considerable tightening of monetary policy already in many emerging market countries. We also have the uncertainty about the sovereign debt situation in Europe, and we have problems of fiscal consolidation that need to be faced in most of the advanced economies, and we face the issue of, at some point at least, moving monetary policy back from extraordinary ease to at least neutrality. So I'm going to spend a little time first on the emerging market and developing countries, and then turn to the industrial countries. Briefly here, the story is that a number of economies bounced back very strongly from the global recession. The growth we had in 2010 is unlikely to be repeated at quite that pace in 11 and 12. That's true for China and for India and the rest of emerging Asia pretty much. In Central Europe and the Middle East, Turkey had a very strong year last year, and they won't quite repeat that. Poland, which did reasonably well last year and avoided most of the effect of the recession, they should do about the same. The rest of Central and Eastern Europe, some of which have had pretty deep problems, should do a little better. So I expect them to be, all of them together, about the same, with Turkey falling back a little bit. In the CIS, well, oil prices are up, and that's helped Russia and Kazakhstan and a number of the others, and they may do a little bit better this year than they did last year, but not much of a difference. Mark will talk about the Middle East and North Africa. There, I have tentatively cut the growth forecast this year to 1%. Egypt is one of the largest economies in the region, and it's clear the disruptions are going to have some important negative effect on GDP growth in the first half of this year. On the other hand, the major oil exporting states are spending a lot of money to buy off social protest, and that may, if anything, provide a little bit of a boost to economic activity, certainly to imports. So I still expect positive growth for the region as a whole, but the turbulence will cut into it considerably. I want to focus mainly on the advanced economy, since my two colleagues are going to deal with the developing countries. When we look at the advanced economies, first, Japan. Japan, obviously the earthquake and the tsunami and the nuclear accident are taking their toll. GDP in March will undoubtedly drop, and April looks like we'll have a fair degree of disruption as well. The first half of the year will be no better than zero GDP growth. But I expect that we'll get a fairly powerful recovery beginning in the spring and then gathering strength in the second half of the year and following. And so while the growth will be strongly negatively affected this year, it will pick up again next year. Australia and New Zealand, not quite so extreme, but basically the same story. The floods in Queensland in January, the earthquake in Christchurch are going to have a negative effect in the short term, which is going to pull GDP growth down this year, but the recovery will push it back up again next year. The Canadian economy has been doing fairly well, and if we look at how we've done during the recession and recovery, the Canadian economy is really the only country which has come back to a GDP level that is above where we started the recession. The U.S. is barely above it as of the end of the first quarter. All the rest of them are below it. There's still some slack in the cooler areas of the Canadian economy, that is to say, not mining and oil. And so I think GDP growth a little above potential in the 3% range rather than 2.5% is a reasonable forecast. All right, that brings us then to Western Europe. And as this chart reveals, the United Kingdom and the Euro area, Western Europe more generally, remain well below output levels before the recession started. Their recessions were fairly deep. They came a little later than ours, and the recoveries have been fairly tepid. Though I would have to note that last year's recovery, despite all the fears of the sovereign debt crisis, actually turned out to be very close to my forecast of 2% positive growth, thanks to Germany, which turned in 3.5% year-over-year growth last year. Well, I anticipate that the United Kingdom will have a relatively sluggish but still positive growth year, 1.5% or thereabouts. My forecast is actually a little above the midpoint of the range. But the entire range of forecasts for the UK this year, in the consensus forecast and in the blue chip, it should be in the Economist poll, everybody in the range is positive. And I take note of that because the UK has a very substantial fiscal consolidation underway, and nevertheless, with the aid of the depreciation of sterling, forecasters generally think that growth will be positive. So fiscal policy, fiscal contraction is having a negative effect on growth, but it's not overwhelming even for a fairly aggressive fiscal consolidation. And that's, I think, a message that's relevant to a number of other countries, including the United States. In Europe, there is a wide disparity of situations where Ireland and Greece and now Portugal are in deep trouble over their sovereign debt situation. Their growth is going to be negative or not much above zero, but others should be doing a little bit better, growing at potential or a little more strongly. Well, that then brings us to the United States, and we can ask, oops, I think I've got. Yes. What went wrong with my forecast of 4% growth last year, and more generally the recovery of 6% or better growth for the 6 quarters ending at the end of last year? And this breaks down the forecast and the results. We got a $571 billion gain in real GDP versus a forecast of 838. So we fell well below my forecast for GDP growth. Part of the reason for that was consumption, but actually the forecast for consumption was it would grow by half as much as the increase in GDP as households raised their savings rate. And we came very close to that half figure, a little above it. Net exports and government purchases also came very close to forecast. Government purchases were a little weaker, state and local governments were a little weaker, and the federal stimulus program was a little less than what I expected. But the main problem was with the forecast of investment. And in investment, well, inventories were stronger, equipment and software was stronger, structures, non-res structures, was basically bang on. The problem was that housing investment did not recover as I had anticipated. And as has been the pattern in every business cycle prior to this one, housing starts to shrink before the recession for the economy as a whole starts. It then bounces back strongly with the recovery of the overall economy. That just didn't happen this time. And when we look at the significance of what's been happening in residential investment, from the peak to the trough, peak of residential investment to the trough to the business cycle, we lost $450 billion of residential investment. From the peak to today, we lost $458 billion of residential investment. In contrast, the entire decline in GDP during the recession, peak to trough, was $554 billion. So much of the decline in GDP during the recession, 80% of it, can be attributed to the fall off in housing investment, which just has not come back at all from where we were at the recession peak. Now, housing was only 6.3% of the economy at the peak of the housing boom. It's now 2.4% of the economy. So that's where the problem of having a recovery that is less dynamic than we would normally expect primarily lies. Why is that? Well, I don't think it's uncertainty about the effects of Obama's health care program. That doesn't really work in the residential sector. Nor do I think it's regulation of the mortgage market, or that may have some marginal effect. Main problem has been that in this residential boom, unlike any preceding boom, it affected not only investment, it also affected prices. Real residential prices doubled between 2000 and 2006, and they've now fallen by a third, so they're about a third above where they were. And that drop in prices has enormously disrupted the entire residential market. And despite the actions of the Federal Reserve to cut interest rates, the takeover of Fannie and Freddie, continuing funneling of credit to the housing market, and efforts at some mortgage reform, this is a problem which is going to just take time to work itself out. We built up a big problem, had a big party, and now we're experiencing the hangover, and it's going to take a while to recover. Now, my forecast for the U.S. economy, here, look at the fourth quarter to fourth quarter figures, says we're going to have a fairly good year this year, 3.8% growth. I was considering pushing it up to 4.3, but recent events have caused me to cut back a little bit. But falling next year. Key reason why I expect slower growth next year is, if you look at the government purchases, that I expect government purchases to shrink by about 2.5% over the 2 years. And that's actually the smaller part of the effect of fiscal consolidation. The 2% cut in the payroll tax is due to expire next year. The incentive for business investment through full expensing expires at the end of this year. Other tax cuts are also temporary. Now, I think some of those things will be partially extended, and the forecast assumes we don't get it all. But there will be additional tightening of fiscal policy at the state and local level and at the federal level as well. So fiscal policy is going to be an important negative. What's offsetting it is, well, I assume that housing will begin to turn around a little bit this year and significantly next year. I also assume that with a highly competitive dollar and with strong growth in the rest of the world, that U.S. exports will continue to grow at about a 10% annual rate this year and next. So the strength in exports and the beginnings of a powerful recovery in housing are going to offset much of the downward pressure from a tighter fiscal policy and keep growth in a respectable range. If we achieve those results, then I would expect the unemployment rate to fall further to about 7.5% by the end of next year. Finally, what about monetary policy? I was not particularly a fan of QE2, but we've got it, and I wouldn't stop it at this point. But I don't think we really need more of it either. The problems with the U.S. economy and the recovery are something that even easier monetary policy is not really going to fix. And I think key danger with it is not simply that at some point it will generate inflation, but the last time we did this in 2004 to 2005, we got the housing bubble, at least as part of the consequence, and we're now trying to unwind that mess. So I think there's a problem with having monetary policy too easy for too long. It's exceptionally easy now. I don't think we need more of it. And this forecast assumes that the Fed will stop at the end of June, and that monetary policy will begin a gradual process of tightening late this year and end in 2012.
Well, thank you, Fred, for the introduction. I'm delighted to participate in this event, and I want to start out by just quickly reviewing how China came through the global crisis in the first year of recovery, and I think its performance, quite frankly, as Fred already indicated, is really stellar. Whether you're looking at output growth, growth of trade, growth of foreign direct investment, China is a big outlier. Its growth slowed down a bit in 2009, but not by very much, reaccelerated last year. Its trade growth fell in 2009, but not by nearly as much as global trade fell, the biggest decline in 60 years. Last year, China's trade growth was very, very robust, as you can see in the diagram, putting its trade in 2010 well above the previous peak, whereas global trade in 2010 did not recover to the 2008 level. China had a slowdown, obviously, in foreign direct investment, but nothing like the huge negative change globally. And then last year, global FDI stagnated basically at the very low levels of 2009, whereas China recovered by around 25%. So I don't think it matters what metric you use. China looks very, very strong. I think there are many factors one could point to, but I always emphasize three. First, China's financial institutions had de minimis exposure to the kinds of toxic financial assets that were generated by Western financial institutions. It began or went into the crisis, again, the opposite of many other developed countries, with very low levels of debt, not in the corporate sector, in the household sector, and in the government sector. And they had a very, very strong stimulus program, which was large, early, and well-designed. It got underway in the fourth quarter of 2008 and continued all the way through last year. So a pretty stellar performance. Nonetheless, as Fred indicated, there are a lot of critics out there who say that this growth was achieved in the short run, but the seeds for long-term problems have been sown, and that we should anticipate a fairly sharp slowdown in China's economic growth going forward. And I'm just going to quickly run through some of these criticisms, 7 of them in particular. The one that has gained a lot of attention recently, of course, is the threat of inflation, and that the authorities will have to step on the brakes fairly sharply sooner rather than later, and that monetary tightening will lead to a sharp correction, slowdown in GDP growth. This is a diagram that shows you the monthly increments of new credit coming out of China's banking system, and you can see there were some staggeringly large increases in the first half of 2009. But I would assert that monetary tightening has actually been underway now for more than a year. And if you look at it in terms of annual growth rates, 2009 was spectacular. Credit expanded by more than 30%. Last year, we're down to 20%. In the first 2 months of this year, we're down to a rate in the mid to high teens, something in the neighborhood of about 17%. I think as we continue through the year, we will see some further slight reductions, and we'll be back to a situation where we will have monetary growth that's roughly consistent with GDP growth of 9 to 10% and inflation in the neighborhood of 3 to 4%. Year-over-year inflation last year was 3.3%. So I don't see a dramatic slowdown in China's economic growth in response to substantial further tightening to bring inflation under control. I think they are converging towards a path of monetary growth that is consistent with price stability, and that convergence has been underway now for quite some time. Now, another argument is that another critique is that this huge increase in credit, this argument is in some ways the opposite of the first. The huge increase in credit going mostly to state-owned companies is going to produce a lot of excess capacity. It'll put downward pressure on prices, and then profits will fall, and we'll have a substantial increase in non-performing loans, and there'll be a fiscal cost for further bank recapitalization. My take on that is to look carefully at what's happening to medium and long-term loans. These account for about 60% of the loans coming out of the financial system. These are the loans used to finance fixed investment, and as you can see from this diagram, certainly in 2009, half of all these loans went for infrastructure projects. The manufacturing sector only got about 10% of all of the loans extended of medium and long-term tenor, and that hasn't changed very much in the first 3 quarters of last year. Manufacturing's up a teeny little bit, infrastructure is down, but this does not look like a banking system that's pouring lots and lots of money in traditional state-owned industries, particularly in the manufacturing sector. And when you drill down a little bit, for example, and look at the steel sector, which is considered to be the kind of best example of an industry that has tended towards excess capacity in recent years. If you look at overall investment in China in 2009, it rose by 30%. Investment in steel went up 3%. In 2010, overall investment went up 25%. Investment in steel went up 6%. So I don't see much evidence of the creation of excess capacity that's going to come back and lead to falling profits and an increase in non-performing loans and have fiscal implications for the government. The third criticism focuses on the so-called property bubble, and this is their official index of prices in 70 cities, and the shaded areas show time periods in which the government has instituted special macroprudential measures to control or to mitigate the increase in housing prices. And I think the general argument I would make is that the monetary authority, for a period of more than 4 years, has been relatively successful in considering asset prices in the conduct of its macroprudential policy. In the periods that are shaded in very light pink are the periods in which they have imposed these measures, and they're basically of 3 types. First, they have increased the down payment requirement if you're taking out a mortgage for a property that you're not going to live in. It's not going to be your principal residence. The normal down payment is 20%. In the period when these measures have been in effect, originally in the first shaded period it was 40%. It started out 40% in the second shaded period. Then it went up to 50%. And as of January this year, if you want to buy a property that you're not going to have as a principal residence, you have to come up with a down payment of 60%. The second penalty for investors or speculators or whatever you want to call them is that the interest rate you will pay on a mortgage for a property that's not your principal residence is much higher than a mortgage for a principal residence. And the premium in terms of the interest rate has varied over time in these periods when these asset targeting measures have been in effect, but it's never been less than 30%, and some periods it's 60%. The third instrument that they use is China has not yet implemented on a widespread basis a property tax, but they do have a property transactions tax, which is 5.5%. In normal times, if you hold a property for more than 2 years, you're exempt from paying the tax. To discourage speculators or investors, whatever you want to call them, in the periods when asset targeting measures are in effect, you have to hold the property for 5 years in order to avoid the tax. So these measures are very specifically focused not just on housing, but on buyers of multiple property. There's nothing in these measures that discourages first-time buyers. Well, you can see the results. Within a quarter of the time these measures are instituted, prices begin to moderate. This is all on a year-over-year basis. Prices, yes, are still going up, but they go up at a slower and slower rate, and you can see that in the first period, they actually went into negative territory in the closing months of 2008. The measures were taken off at the time of the Lehman crisis as China saw that its export engine was weakening. They wanted to ramp up the domestic property market, and they took the measures off. By the closing months of 2009, early 2010, prices were heading up towards a double-digit range again, and they reinstituted these measures again. With a one-quarter lag, prices started to moderate, and then we had 8 consecutive months of price decline. So I don't think we're heading for a property bubble in China, and I think the regime has not gotten sufficient recognition, quite frankly, for the fact that it's ahead of the United States and most other advanced industrial countries in managing the role of the property sector and avoiding property busts. Remember, in the first instance, we had the air went out of the bubble. It was not a bust. We had several months where prices declined in absolute terms, but the cumulative price correction was in the neighborhood of 5 to 10%. The other factors I would mention, of course, are that leverage in the household sector is still relatively low. It's picked up a bit in the last couple of years, but total household debt as a share of disposable income is currently around 50%. And pre-crisis in the U.S., the figure was more like 150%, and I think in the UK something in the neighborhood of 175%. So I don't think they're going to have a property bubble that has major systemic consequences for the financial system. The fourth criticism that is frequently mentioned is that all this burst of lending was just pumping up investment, and since China's long-term goal for several years has been to try to get on a more consumption-oriented growth path, that this was a big setback towards that long-term objective. And here I would say, first of all, the stimulus program had quite a bit in it, didn't get all the headlines, but had quite a bit in it that was designed to stimulate consumption. They increased transfer payments, they increased payments to pensioners quite substantially. They had price incentives in the rural areas for purchase of consumer durables, in other words, tax expenditure, if you will, cutting the tax rates on some of these products. Household borrowing, as a consequence, went up substantially. If you abstract from mortgage borrowing, the increase in household borrowing in 2009 and 2010 was equal to 1% and almost 4% of GDP. Some of that borrowing went to finance consumer durables, vehicles, and so forth. And the result was that for the first time in 9 years, the consumption share of GDP, as measured by the Chinese, did not decline. In other words, 2009, it flattened out. We don't have the 2010 data yet, so I can't answer the question of whether or not we're coming off the bottom or whether it was just a pause and a long-term decline. But there was a substantial portion of government policy that was pro-consumption. And in part, it was possible because the initial level of household debt, as I indicated at the outset, was relatively low. So China's growth, in part, has been a re-leveraging story, with households taking on more debt to support higher levels of consumption. I guess I'm up to number 5, which looks at the question of the debt of the government. And of course, the headline figures for Chinese government debt are very favorable, debt to GDP ratio of about 20%. But a lot of the lending that was, also I didn't mention this, the structure of GDP also changed a bit. Services share of GDP rose more rapidly in 2009 than in any period, any year in the previous decade. Oh, I'll mention also the external imbalance. A lot of people were saying, yeah, China's external imbalance came down, but as soon as the global economy begins to recover, it will go back up. This is looking at goods and services. And you can see, yes, the decline was fairly dramatic in 2009, but even when global economy began to recover last year, the V-shaped recovery that Mike talked about, China's net exports of goods and services rose very slightly in absolute terms, but as a percentage of GDP continued to fall, reaching about 3.9% of GDP last year compared to the peak of about 8.8% in the year 2007. So if you're worried about a currency war or increasing protectionism or whatever you want to call it, stifling China's economic growth, maybe the possibility that this is going to happen is lower than we had thought. Maybe rebalancing in terms of the external imbalance has moved further along than many people anticipated. I guess I don't have a slide on the fiscal sustainability, but the question here is the debt of local governments. A lot of the borrowing that was done in 2009 and to a lesser extent in 2010 was undertaken by local government agencies, sometimes called platform companies or conduits, local investment companies. And by the end of 2009, the debt of these local investment companies was actually larger than the outstanding central government debt that we always talk about. And many people have argued that local governments invested in a lot of white elephants. The projects will never pay off. There'll be a big cost to the financial system. Well, most of the money, in fact, has been used for infrastructure projects, metro systems, water systems, and so forth. And my view is that the economic returns to these projects are likely to be fairly high. China is undergoing a fairly rapid pace of urbanization. The demand for the services provided by this kind of infrastructure investment is quite substantial. The economic problem the problem is not the economic return, it's the financial return. A lot of services in China are underpriced. Every water company in China has lost money continuously since the mid-1990s. Water is underpriced. Subway systems all lose money in China, just like they do in every other jurisdiction around the globe. So the solution has to be some combination of increased prices for services, or that local governments are going to have to repay a lot of this debt from general tax revenue that I think will be the incremental tax revenue that will be generated by the higher growth that the infrastructure makes possible. So I don't think this is going to come back to lead to widespread defaults on bank debt with problems for the financial system. I guess my last critique to look at is the argument that the reform really reflected or had led to the rise of the state, a rollback of market reform. The Chinese have a phrase for this, guojin mintui, that is, the state is advancing and the private sector is retreating. And so we have moved from a market-oriented reform process that we have seen in China for several decades to a much more state-driven one. I will tell you I'm skeptical. When I look at the evidence, I don't see that this is a very strong case. And I start out by looking at who's able to borrow money, particularly during the last 2 years. And we don't have good data on lending by ownership, but we have some very good proxy data. Small firms are almost entirely private. Medium and large firms tend to be mostly state companies. And as you can see here, the growth of lending to small firms, the private companies, actually in both 2009 and 2010 was substantially greater in percentage terms than the growth of lending to medium-sized or large-sized firms. And small firms are now so important that the absolute amount of credit that they borrowed in 2010, shown in the very top bar, exceeded the amount of money borrowed by the largest state-owned companies. Even more outstanding is the growth of credit to household businesses. I mentioned that households borrowed a lot of money in addition to mortgages. Well, a lot of it went for business loans, small. This is what are referred to in China as the self-employed. These are not small firms. These are little household businesses that have fewer than 8 or fewer employees. And you can see they had an absolutely explosive growth of borrowing in 2009 and 2010. I didn't put it on the diagram, but if I had shown you the number for 2008, the growth of their borrowing of these self-employed individuals in 2008, the year before the crisis, was about 10%. They borrowed about little less than 200 billion RMB. So a very, very substantial change in the structure of lending going on during the stimulus program, with a great deal more money going to, to self-employed individuals and to private firms, and much less money going to big state companies. So the popular idea that bank lending by state-owned companies, by state-owned banks, is going mostly to state-owned enterprises and are starving the private sector for credit, I think is simply not true. And this, of course, is also borne out. Where's the growth coming from, particularly in the manufacturing sector, which accounts for about 2/5 of China's economy? Again, you see in both 2009 and in 2010 the growth of the private sector. And here we do have, this is by ownership. This top two bars are the true private firms. Then we have some intermediate forms of ownership, and then we come to the state ownership. And private firms grew much more rapidly than anybody else in both periods. So in addition, I would say that this idea that this stimulus program resulted in the ascendancy of state capitalism over market capitalism, I'd say there's really not much systematic evidence to support this. In the last couple of years, private firms have become the drivers both of industrial growth and of exports. China's private firms have roughly doubled their share of total exports over the last few years. They exported almost $500 billion in product in 2010. Well, let me quickly say a couple of words about the 12th five-year plan. The 12th five-year plan does have a strong agenda for rebalancing China's economic growth. I won't go into any of the details. But the critics say, of course, we've heard this all before. The Chinese have been talking about this for years, of a number of policies in various domains that would lead to more rapid growth of consumption and the scaling back of the dependence on investment and net exports. Will this time be different? Well, we'll have to wait and see, but there are at least two reasons for thinking that it might be. First of all, I think the global environment has changed substantially. Yes, we've had a V-shaped recovery, but I still think that we have relatively slow growth in the U.S. and Europe over the next few years compared to the years leading up to the crisis. So external demand cannot be the same driver of economic growth as it was in the period, particularly, say, in 2005, 6, and 7. And secondly, domestic investment, I think, must moderate. And I say that for two reasons. I do think the infrastructure investment does have high returns, but China cannot sustain the pace of infrastructure investment that we saw in 2009 because to some extent they were building ahead of demand, so that can't go on indefinitely. And I still think property investment is too high. Mike mentioned residential property in the U.S. peaked at 6% before the crisis on an annual basis. Well, China's residential property investment last year was 10%. So they need to moderate investment further. If the external environment is going to be relatively weak, as I've suggested, I think the alternative to rebalancing, that is to relying more on consumption, is going to be slower growth. And although Chinese leaders may stand up at their National People's Congress and say the growth target should be 7% instead of the previous target of 8%, we all know they want a very substantial growth rate, and I think there's a recognition they're going to have to rebalance in order to achieve it. So in conclusion, I don't see a substantial slowdown in China's economic growth as a result of the flaws in the stimulus program. I think China's growth is more strongly than ever now driven by private market-oriented activity rather than by non-market-oriented economic activity organized by the state. And I think they have made some progress in rebalancing the sources of growth. Consumption looks stronger over the past couple of years compared to the earlier years. The external surplus has declined dramatically compared to the peak levels back in 2007 and 2008, and we'll just have to wait and see if they actually carry out a lot of the policies that have been advertised before and carry them out with enough strength so that the rebalancing is achieved and the growth is sustained at very robust levels. Thank you.
Well, thank you very much. I'm delighted to be here. In Fred's introduction, he described me as, he likened me to a derivative product that could, and I'm quoting here, that, well, you could have, quote, bought it cheap and made a lot of money. Where's Fred? Maybe I should ask for a salary increase. We have this on videotape, and I have 200 witnesses. I was originally advertised to speak on the Middle East, and as Fred indicated, events intervened, and so I'm also going to address the situation in Japan. So let me start there. On March 11th, northern Japan was hit by a 9.0 magnitude earthquake. It's one of the 5 largest earthquakes recorded since the advent of modern seismology 100 years ago. The official death count at this point is over 12,000 people, with another 15,000 missing. It's a truly horrific experience. Sadly, Japan has long experience with earthquakes. On September 1st, 1923, the Tokyo metropolitan area was hit by a 7.9 magnitude earthquake. An estimated 140,000 people were killed. 3 million people were left homeless. This is a photo of the posh Ginza neighborhood in Tokyo, taken in the days following that earthquake. While the Japanese have a sad experience with earthquakes, they also have considerable experience with rebuilding. That's the same neighborhood 2 years later. In January of 1995, the port city of Kobe was hit by a magnitude 6.9 earthquake. 6,437 people were killed. Damage was estimated to be at least 2.5% of GDP. And I don't have the same before and after pictures of Kobe that I do of the Ginza, and for those I should thank Arthur Alexander, who's sitting here today. I can tell you from personal experience that if you visited Kobe before the quake and then you visited it a couple of years later, you would have seen a city absolutely transformed. Indeed, economic activity in Kobe reached its pre-earthquake level within 18 months. One certainly hopes that the response to this latest disaster will follow the pattern of those earlier experiences in a very rapid recovery. There are 3 sources of uncertainty, however. The first of these, and thankfully it's dissipating with each passing day, is that an aftershock could further destabilize the nuclear facility at Fukushima or hit more populous areas of Japan further to the south. Second, while the operators appear to be making progress, the situation at Fukushima remains unresolved. And finally, while natural disasters are normally confined to a geographically limited region, and in this case, the region of Japan hit by the earthquake and the tsunami account for about 4% of GDP, considerable electrical power generation capacity has been either temporarily or permanently destroyed, and the impact of that effect is being propagated through the electrical grid to the rest of Japan, including the Tokyo area. About 7% of electrical capacity has been either permanently or temporarily taken offline. However, Japan doesn't actually have a genuine national grid. It has 2 grids that operate on different cycles. This limits the possibility of load shifting across the country and has the effect of insulating Western Japan, which includes the industrial cities of Nagoya and Osaka, while concentrating the disruptions in Eastern Japan, including the immediately affected region and Tokyo. So in terms of recovery, an important issue is how rapidly consistent electrical power generation can be restored in that red grid. And that part of that can be done by bringing back online capacity that has been temporarily taken offline. Partly that can be done by installing additional transformer stations to permit additional load shifting from Western to Eastern Japan. Partly it can be done by conservation of non-essential uses. But that it remains a major uncertainty. Estimates of the damage recovery costs vary widely, but most, including the government's official estimate, cluster around 25 trillion yen, or a bit more than $300 billion, or somewhere between 5 and 6% of GDP. Despite the government's weak fiscal position going into this crisis, that appears to be financeable. Recovery can be financed partly by expenditure switching. One of the reasons that Japan is in the fiscal mess it's in is decades of extraordinarily wasteful spending on public investment. White elephant projects that were driven by the wildly disproportionate influence that lightly populated rural districts had on national decision making. So part of the financing rebuilding of Sendai and the Tohoku region can be generated simply by stopping, at least temporarily, some of the existing or planned wasteful public investment projects. But the Japanese political system has moved quickly beyond that. They're actually talking about cutting flow expenditures within the budget. Now, this isn't a complete kumbaya moment. There's still politics involved. So the incumbent party, which tends to represent urban interests, is talking about agricultural reform, and the opposition party is talking about cutting child care subsidies. So there's a range of issues on the table. But nevertheless, reductions in current expenditures and possibly tax increases or foregoing anticipated tax cuts is another way of generating funds to rebuild northern Japan. And of course, the government can issue more debt. And for reasons that have been well rehearsed here at the Peterson Institute, the fiscal position of the Japanese government is better than the frequently headlined 200% of GDP accumulated debt figure would lead one to believe. Net debt is roughly half as large. That is mostly held by the Japanese public. And so in terms of issuing more debt, the government has more room to maneuver than many other governments would have under similar circumstances. A lot of interest has been expressed about the impact on the world economy via supply chains. And as Mike argues in his piece, this is unlikely to be macroeconomically significant, though obviously it affects individual firms and their supply chains, and indeed these disruptions have spread internationally, including to the United States. But the bottom line is, in short, this time it will be no different. Japan will recover, Japan will rebuild. Which brings me to the Middle East, where this time it really may be different. Across the region, countries face a similar set of difficult long-run challenges relating to employment, globalization, and political stability, which have come to the fore in the last few months. In the interest of time, I am going to paint with a very broad brush. Of course, it should be said that there is a lot of diversity across the Middle East. And so how things play out in individual countries will vary from country to country, at least one hopes so, given the example of Libya. The fundamental challenge that the region faces is the demographic imperative to create jobs, particularly for politically volatile, urban educated youth. The region has the world's lowest employment rate. Youth unemployment is roughly twice the world average. On the back of the commodity boom of the last several years, the situation has been improving. Measured unemployment has come down across the region. And some of this is real. Some of this is a bit of an illusion, where the numbers disguise underlying labor market problems, particularly in North Africa, where much of the official job growth numbers are accounted for by public works employment, agriculture, and where productivity is actually declining, and a liberal classification of informal homework as and cottage industry activity as formal employment. With some exceptions, employment has not been growing in industries where productivity is increasing, suggesting that it does not appear to represent an expansion of rising dynamic sectors. Estimated unemployment for young people aged 15 to 24 is more than 25%, roughly double the world average. And it is positively correlated with educational attainment. In Egypt, for example, the likelihood of being unemployed for a young college graduate is nearly 10 times that of someone with an elementary school education. And while Egypt is the extreme case, it is not alone. This positive correlation between educational attainment and unemployment holds for every country for which the data exist. Now, lurking beneath the surface in all this is politics. And while the region's contemporary economic performance may not be distinctive, its enduring authoritarianism is. What the last 3 months have shown is that the region's apparent stability may be just that, apparent, and may in fact mask brittleness, something that Howard Pack and I argued in our book, Arab Economies in a Changing World, that Fred mentioned in his introduction. The Middle East region really is unique. On the left-hand panel is data from the Polity 4 project. This is a project that's run out of the University of Maryland, in which political systems around the world are rated on a scale of -10 to +10. I don't know why our scale goes all up to 12. I guess we're into the supernatural. -10 is absolute despotism. +10 is democratic nirvana. And what you can see is, of these broadly grouped regions of the world, the Middle East North Africa region is the only one that is below 0, that tends more towards authoritarianism. Moreover, if you look at the right-hand panel, that's the number of regime changes over a period of 45 years. And regime change in this context has a particular definitional meaning. It doesn't mean regime change the way the Bush administration was practicing it. But the point is the MENA region is the world's most stable, other than the big industrial democracies of the OECD. So it really is unique, combining authoritarianism with apparent stability. Now that situation is ironic in certain respects. Over the last 2 generations, the region has experienced truly impressive improvement on a wide variety of social indicators, such as life expectancy, infant mortality, literacy, educational attainment, narrowing of gender differences, spectacularly so in some cases. And neither absolute poverty nor inequality outside the oil producers is high by global standards. But despite that, polling data suggests that these in general are not very happy populaces. Response patterns indicate that the discontent is related to principally to concerns over employment and lack of a political voice. So those are the 2 themes. It's employment and political voice. Now, in the short run, as my colleagues Mohsen Khan and Svetlana Miltberg have documented, many of the region's governments are busily handing out bonuses, hoping to forestall opposition, as I think Mike mentioned in his presentation. All the countries experiencing political instability, particularly those without energy resources, could face financial crises, capital flight and contraction, and a need for external balance of payments support, either from the International Monetary Fund or some other sources, such as Saudi Arabia, either directly or routed through some intermediary, or perhaps even China, which might be interested in seeking enhanced diplomatic influence and access to critical energy supplies. In the medium to long run, however, the underlying structural issues are going to come back to the fore. And there are 2 broad possibilities about how these regimes may respond. In the optimistic scenario, enhanced political legitimacy as the previous authoritarian regimes are displaced could create a political space for reform. In the countries lacking a superabundance of natural resources, like Syria, for example, a new government could begin dismantling the rent-creating economic distortions that have been used to create and hold together political machines that have contributed to inefficiency and corruption. And in countries with supernatural abundance of resources, like Libya, for example, resource-derived rents could be redirected away from vanity projects and into a more constructive direction. Political liberalization could unleash entrepreneurship and dynamism, reversing the brain drain that has very much afflicted some of these countries, and drawing in new technology and investment. A more negative outcome is also possible, however. The newly responsive political systems could actually impede or reverse reforms already underway across the region over the past decade, worsening the long-run prognosis. It is increasingly evident that, rightly or wrongly, these reforms, which have been undertaken with varying degrees of enthusiasm across the region, are widely regarded by the region's publics as having contributed to inequality, corruption, and in the context of rising food prices, impoverishment. So, which way might the new political forces go? If you listen to what the region's public say, they do not appear to be particularly anti-market, but they do appear to be skeptical of neoliberal reforms and globalization. For example, in a Pew poll, only about a third of Egyptian respondents indicated support for closing large inefficient factories, even if such closures brought greater prosperity in the long run. In the national capitals, a prime source of extra electoral instability could be unemployed urban youth, and whoever ends up heading these new politically less secure regimes will be sensitive to their needs regardless of ideology. One obvious response would be populist policies. Despite the lack of a populist tradition, it would be hard to imagine that no politician would not advance a platform based on catering to public employees, the unions, and consumption subsidies for everyone. Call it Peronism of the East. The problem is that a key constituency to be mollified is urban educated youth, as I showed in the previous slide, many of whom have majored in subjects that do not map easily to the demands of private employers. And while a Keynesian program of public investment might be understandable and self-limiting, the natural temptation under these circumstances will be to permanently expand public employment and the size of government. And while macroeconomic management in the region has generally been pretty good, countries without the resources to fund such binges could face macroeconomic crises, collapse of the exchange rate, bringing the IMF back into play, and revive concerns about globalization, neo-imperialism, and so on. The wild card in all of this for both the region and for the world itself, as Mike mentioned in his presentation, is the path of commodity prices. Depending on how the instability spreads or doesn't spread among the energy suppliers, one could imagine a wide variety of price paths. For example, if oil production in Libya is disrupted for a significant amount of time, the price of oil will rise, as we've seen it already has. That will hurt the oil importers within the region, but it'll actually benefit the oil exporters who will have greater revenues to buy off local opposition, or in the case of Saudi Arabia, actually help out its neighbors, as it is attempting to do in Bahrain and will presumably try to do in Yemen as well. Then you have a bunch of second-order general equilibrium effects through the world economy on remittances and so on that are going to have varying impacts across the region, depending on the linkages of specific national economies to the outside world. Rising food costs have contributed importantly to discontent, but the regime's government have little control over those costs at the world level. Now, they can insulate their publics through subsidy schemes, which some of them do, but they have little control over that. And further increases could aggravate the situation either directly by contributing to rising domestic food prices or putting a greater squeeze on the government budget. Or likewise, if world food prices come down, it could be a political windfall, either by generating lower prices to the public or by freeing up other resources in the state budget. So in short, the region faces real economic challenges. It's possible that political honeymoons associated with the relaxation of authoritarianism could generate greater leeway for governments to pursue reform, but it's equally likely that the political disruptions could set internal and external dynamics in motion that would make addressing the underlying economic issues much more difficult and contribute to an environment of political instability for a sustained period of time. For the rest of the world, as my colleague Mohsin Khan has pointed out, the immediate narrow impact of these events in the Middle East has not been great in the economic sense, at least, for those not directly affected. The global economic issue is potential political contagion to the Gulf countries, which together supply about 15 million barrels of oil a day, or about 17% of world production. Egyptian or Tunisian or Libyan, hope not, style political unrest obviously has the potential to create supply disruptions in Saudi Arabia, Kuwait, and the UAE. Major oil price increases, as we saw a couple of years ago in 2008, certainly can't be ruled out, and as Mike has indicated, would be very harmful for world recovery. However, the possibility of those sorts of major supply disruptions with significant amounts of oil being taken off the market would seem to be rather small in the near term, at least. Thank you very much for your attention, and I look forward to our discussion in our remaining time. And I look forward to my next annual review with Fred.